Good morning, everybody. My name is Madeleine Boys. I am the Director of Programs in Innovation at Global Digital Finance. We're an industry association that do a lot of work engaging regulators and policymakers to help develop best practices for the industry. It's my pleasure to be on stage for the second time this morning to moderate an all-star panel, and I will let everybody introduce themselves. I do just want to flag, though, that unfortunately Stephan, Dreyer, who you see on the pictures, wasn't able to make it. There was a bit of a mix-up with his flight, so instead we have Heidemann sitting just next to me, who is filling in his shoes. So as we get into it, can I just ask everybody to give a bit of an intro? Heide, why don't we start with you, and I can lend you my mic.
Thank you. Good morning, everyone. Pleasure to be here. Heidemann, I'm the CEO of BigTXN. We are a data processor. I've spent majority of my career as a computer scientist working on innovative problems within the TradFi world. And then the last couple of years of my career have been in trying to build a bridge between TradFi and DeFi. And so today we have a claim that we are one of the largest processors of financial instrument data worldwide. We produce the the digital asset master file, and that is something that I'm going to be touching upon today in terms of the bridge between TradFi and DeFi in Stephan's absence. I'm also going to share some thoughts on my experience with the regulatory conundrum that we're in with the evolution of DeFi. Thank you.
Hey, Ben Duve. I recently, or just a few days ago, joined GK8 as the new global head of partnerships. GK8 is Galaxy Digital's custody solution. And well, for me, a natural progression to go from large organizations like BNY, Commerzbank, via the central bank now to the core of where the DeFi, CeFi revolution is happening. And I think that's at the wallet stage, right? And asset safety, running a custody business before asset safety is such a core piece of that whole value proposition. And if you look at GK8, the solution provides an impenetrable vault, so a solution that truly and uniquely secures your assets while still being usable, having tokenization, so all the great stuff you want, but safer. So I think that's my background.
Hello, everyone. I'm Rowan. Hello, Madeleine. First of all, I'm excited to be here with you in this conversation. I'm the CEO and founder of Vixi Chain. Vixi Chain is a leading decentralized and compliant blockchain that basically came here to bridge the gap between traditional finance and decentralized finance. This application that we're developing is basically involve banks as blockchain validators and basically bringing the DeFi by accepting the idea of self-custody while bringing the banks to be the safeguarders of our economy. So basically, the banks are the one that approving each transaction while the users are still in DeFi space. Thank you for having me here. Thank you.
Hello, thanks for inviting me today. I'm Coty de Monteverde. I'm leading the Crypto and Blockchain Center of Excellence of Banco Santander. Santander is one of the largest banks in the Eurozone, and we placed our bets on blockchain technology 8 years ago when we set up our blockchain lab. Since then, we've been working in our extensive program on digital assets, from tokenized securities, digital cash, to collateral mobility solutions. And we're also now working on crypto as well, and we are providing custody and trading services to our private banking clients in Switzerland.
And I'm Rowan Varrall from the DTI Foundation. We're the registration authority for the ISO Digital Token Identifier Standard. We work closely with regulators and the wider industry as this standard is being adopted across different crypto and digital asset markets, from security tokens, stable coins, the wider crypto universe as well. So that's me.
Thanks so much, everybody. So I think one of the things that makes me really excited about this panel is just, I think it's one of the recurring themes that we're hearing in a lot of the discussions today, but just generally speaking in industry. And when I think about it, I really think about the process that's been. I think that for many in the room here, we've been in this industry for quite a while now, what feels like quite a while, but there's been slow but steady progress in terms of this convergence with a arguable recent escalation. I think one of the panels that I heard earlier this morning was looking at the data that really speaks to growth of tokenization markets. So you're thinking a few million in 22, a few hundred million in 23, and now we're really moving into the billions. So I think there has been a very slow but steady progression there, which is really interesting. And we have a wonderful lineup here with folks with very different backgrounds that can speak to that perspective in terms of the evolution that we've seen in the market. So, Coty, can I maybe speak with you, and we'll ask you to speak to sort of that 8-long-year journey and how you really think that the market has pivoted in the past year in terms of that convergence?
Yeah, sure. So I think that in the last years, the progress has been quite slow. I mean, we've been working at Santander 8 years with this technology, and feels like decades. But 2024 was an important year where I see that this convergence is accelerating. We started the year with the approval of the spot crypto ETFs in the US. And I think that was a great milestone to get closer traditional financial systems and crypto. We saw institutional players that, that they were maybe scared about custody and operational hurdles in getting into the crypto world, and now they can access fully regulated products to get exposure to crypto. So I think that was a major step this last year. And then also another area that its progress has been quite gradual has been tokenization. But also 2024, I think that there were important milestones or key things happening, like, for example, the tokenized money market funds got all the headlines in the US. And that's because, I mean, we all know all the advantages of tokenizing financial products, but it's kind of theoretical, but with this we've seen that you can apply it to real regulated, widely used products such as money market funds, and I think that was very good also for the tokenization space. But also there's, I mean, many obstacles as we are going to discuss today. One is regulation. In Europe, we've got the pilot regime up and running, and supposed to be to help innovating in the tokenized securities space, but adoption has been very, very slow. So sometimes regulation helps, sometimes not that much. This was not the case, but with MiCA, we've seen a lot of progress. So I think that was another key milestone for 2024. Having a clear, unified regulatory framework all over Europe is going to help traditional financial institutions to get into this space now that they've got regulatory clarity.
Thanks so much. And I mean, it's certainly been a journey, and I think a lot of what you mentioned, I think, are really the exciting touch points that we're looking at least from sort of an institutional adoption perspective, going into 2025. But Heide and Roy, I wondered if you have any sort of additional input from the tech native side in terms of how you've really seen that evolution over the past few years and escalation, I suppose, in 2024.
First of all, I will say that, in my opinion, we did tremendous job when it comes to crypto and fiat integration, or traditional finance and decentralized finance. We need to understand that this is the internet money, right? And it was decentralized at the beginning through the Bitcoin protocol presented first in 2009. To say that banks will adopt crypto very easily and smoothly, I think it's a very hard decision, first of all. It's not about just regulations, it's about compliance, and we both know it, Coty. I assume that you will agree with me. Now, when it comes to how we are actually progressing, so we need to look just at statistics. The TVL, for example, in EVM chains in 2019 was around 500 million. Today, 2024, end of 24, we're speaking about $121 billion inside EVM chains. Okay, I think it says everything. Now, when it comes to the users, for example, that I think that this is what drives the traditional finance to enter to the game. Today, we're speaking around 560 million users that holds crypto assets. It's around 7% of our global today population. So I think that we're progressing well. When it comes to 2024, yes, I will mention again the ETFs approval. I think that this is amazing to see Fidelity and BlackRock, for example, participating in the crypto space. It says a lot. It's fresh money, it's institutional money that entering to the market, but still we need to remain one thing, that I think that this is the most important thing. Blockchain yet is not our mainstream payment trail when it comes to movement of values or information. And I think that this is a failure. We need to understand that every minute that we are wasting without blockchain as our mainstream, it's a failure, both for traditional finance. Decentralized finance is the most important thing for me, is for the users. The users are basically cannot today do operations in milliseconds and still waiting for days sometimes to move funds around the world.
Thank you. I think an interesting statistic for me is we spend a lot of time focusing on the price of Bitcoin. But in fact, if I can relate to you that during the last 3 years, even before the developments pre the US election last year, there were already about 12,000 issued instruments related to crypto in the traditional financial markets. Today that number is closer to 20,000, and the notional associated with that is over 200 billion. So that shows you how fast crypto and crypto-like assets have already flowed into the traditional financial markets. These instruments are based on your traditional crypto coins and stable coins, as well as also natively issued on digital exchanges. The interesting part of that for me is standardization. How do we then bring this story full circle by associating all the standard facilities and standard parameters that an institutional investor is comfortable with? So issuances having the proper classification, ISINs, CFI topology, and how are they represented? I think the DTIF is doing a great job of creating a standard taxonomy that is usable. We are in fact using it today to represent the underlyings of whether they are crypto or not with the standard DTI identifier and the DTI ISIN. As we now go along, what we're going to see, as you mentioned, sorry if I can be reminded of your name. No, the lady from Santander. Coty. That institutional investors will be seeking out exposure, regulated exposure to crypto, because there is still a discomfort with seeking out and going and directly investing in crypto coins and digital assets, the native issuances. So they want something that is already wrapped for them, that can be delivered under a system like MiFID or one of the already in place or in force regulatory mechanisms. So what we're going to see is a greater adoption of crypto, I believe, through the traditional financial markets than the other way around. And when this happens, and I'm sure that we are not that far away, even with the deregulation in the US now, from seeing an uptake that will push that threshold closer to its first $1 trillion notional in the traditional financial markets because of the number of ETFs and exchange-traded products that are being now issued. For example, 90 applications in 1 week, just last week, for new ETFs to be issued within the next 3 months that are based on crypto coins. Not just Bitcoin, but a numerous number of others. So I'd like to leave you with that thought as I hand over to the next panelist. But that's where we are going with the traditional financial markets and the bridge between DeFi.
Thanks so much. And I think it is a really interesting shift that we're seeing at the moment, but it's about how different assets essentially, what vehicles are bringing those different assets and how they're moving, and in terms of investor appetite, what's enabling, or facilitating that kind of adoption. But Ben, I was wondering, what your general take is in terms of the institutional appetite there for not just, the equivalent of traditional financial securities on chain, but really moving into crypto as well. You have a whole host of experience from tenure at BNY all the way to the policy side of things, at the European Central Bank, and now at Galaxy, or GK8 at least. And I just wonder what your take is on what is driving sort of institutional appetite and buy-side adoption of crypto, and more, like I would say, leaning more into DeFi.
So, well, I did make a little bit of bet more on the DeFi side going into a GK8 Galaxy setup. So you already see from a personal choice, I do believe that's where the movement in the next years will be. And let me split it into two things, right? There's crypto as an investment opportunity. And then there is, I think you alluded to it, tokenization, blockchain, however you want to call it, the infrastructure play to rewire the current capital markets infrastructure, right? Those are the two different avenues we talk about. And then at the adoption curve, and I agree with Coty, has been tricky, but I think it now has changed. It always has been that crypto is the way to make revenues against investments you as an institutional make into infrastructure, right? That's the yield or the return on invest you can get quite fast, right? Because there is a market there is Bitcoin, there are other assets people want to invest in. So if you invest in the infrastructure, get your compliance people, your risk people comfortable with all of that, you have a product that immediately yields returns, right? So I think that part was very mute coming from a US institution, right? Operation Choke Point, however you want to call that. But there was a lack of ability to execute on that use case. I think that hindered, and the US is a great example, that hindered all the discussion on tokenization, how to rewire capital markets infrastructure, because actually at the core is the same thing, right? And that's luckily a solution we provide. So that's maybe the reason I went there. I think at the core, you need to be able to interact with those ecosystems, right? So you build a wallet infrastructure that interfaces with either crypto or more regulated DeFi protocols and ecosystems, right? But you only make that investment if you make money. But now the US has to go ahead, right? So now in the US, you can see, wait, you can make money in crypto. Let's more invest in that infrastructure, that core infrastructure. And by the way, once you have it, to participate and explore the new use cases you have around the DeFi distribution of money market funds, new capital markets infrastructure, that's all works, right? I think that's where the true trend is. If you see revenue opportunities, you invest in the infrastructure and then you play the other plays, tokenization and more DeFi-like instruments. I don't think there's actually any regulatory holdback. I think that's just an excuse. In Europe, you can do everything right now as a regulated institution if you wanted to, right? So I think it's truly and coming from Germany, we had it even for more years. I think it's truly a failure of the industry to embrace the investment opportunities for their clients, and clients have chosen to go somewhere else, right? You see all these different new venues where especially a younger generation goes to buy assets, which are more crypto-minded, where they trade, where they implement certain pieces. So I think that part I don't see there's no real obstacle anymore from a regulatory policy side, right? And then the second piece, the tokenization discussion, seeing it from a central bank, BNY perspective, always has been, we need central bank money, we need common rails, all of those topics. All of that is there, and if you carefully watch some of the speeches held by one of the board members of the ECB, who very clearly said he expects to provide some kind of central bank money within months, not within years, right? If that holds true from an execution point of view, let's see. But I mean, that means also that piece could be there in quite a short period of time. So I think that then calls for the industry to say, wait, now we always said we need regulation for crypto. Well, there's regulation, why don't we have it? Then the second question is, we need central bank money, we don't want the counterparty risk of everything. Well, that might be there as well quite soon. So I think the adoption curve has to speed up. It comes through crypto. I think the institutional industries might be lacking behind, and that's why I think some of the more crypto-native players are currently overtaking. They're accumulating clients. They're accumulating the future client of a bank, right? And now the question is that pressure enough for the rest to wake up and say, wait, I don't want the now 20-year-old guy to bank with someone else who right now provides the crypto investment opportunities they crave. But once the rest of the infrastructure in 10, 15 years is digital, that crypto-native company also has a technological advantage in the traditional realms, right? And I think that's something from a strategic point of view we shouldn't underestimate. And a last point, which I think is very important, people underestimate the risk in crypto when they make their infrastructure decisions, right? We always have to keep in mind, unless everything we know in banking, you cannot call someone a CSD or someone else to give you your asset back. Right, so I think people made very convenient choices up to now because they have like low amounts of crypto. It was a small use case. If you lose some money, that's fine. You just write it off. It's like a PR piece. You lost 15 million, but you got 20 million of PR. That's fine, right? But I think once adoption increases, safety and asset safety will become such a core theme in the industry, and wait for the big theft a year, 2 down the road. I think that we really have to keep that in mind as well.
I would tend to argue that, to me, it's one of the key pillars that has sort of underpinned most discussions that we've had to date about anything with respect to scaling crypto in an institutional context, or the way to, uplifting what is the traditional financial market infrastructure now into purely digital financial market infrastructure. So, and one of the considerations is safety, the other is the cost that goes with it. And so, it's maybe not my place to challenge as a moderator, but on the previous panel that we were on, we were talking about the cost inhibitors for institutions mandated by regulators and policymakers for banks building out these capabilities in custody, for example. So I'll leave that as food for thought. But
that's I know the argument, right? But let's very straightforward say that's the same argument why people said there will never be new banks, because it's very highly regulated, it's very expensive to come into the space. You just need scale. The moment you have scale, costs come down, right? It's a per unit cost. So I think the moment crypto adoption increases, you will get more, you get more users, right? More clients, and then you're able to invest more in safety and security. So it's a function of assets under custody versus invest.
I totally see your point. At that, I don't work at a bank, so maybe this is a bit under the belt, but Coty, I'd love to get your perspective on this and sort of your experience in terms of managing the policy and regulatory challenges for banks in terms of building out, I would say, your digital asset strategy as a whole, looking at both, infrastructure-wise, thinking everything like tokenization, all the way to appetite around crypto.
For us, regulatory clarity is key. We are not going to do anything if we are not sure that we are not getting into trouble, because we have a banking license that it's very expensive to maintain, right? So in that sense, as Ben was separating crypto adoption and tokenization, on crypto, it's true that now in the EU we have a level playing field, and financial institutions can play same game. And well, MiCA has been there for a month, and we'll start seeing banks and traditional financial institutions getting into the custody and trading business. There's no more barriers there, but it's not easy at the same time, because it's not all regulated already. MiCA is not covering staking. MiCA is not covering NFTs or DeFi. So financial institutions are going to adopt crypto assets progressively with the regulation. Then another hurdle that we find is the travel rule, which it's not easy to follow the travel rule, and there's no standardized solutions. It's a bit fragmented as well. But yeah, in the EU on crypto, we can play the same game. Regarding tokenization, that's not that easy. I mean, pilot regime has been there for more than a year. I mean, 2023. How many multi-trading facilities are already operating in the pilot regime? 3? You said 3?
I think 2, 3. I think
21X
I know, and then
potentially just approved as well, not
Axiology,
necessarily
and then
operating.
So it's not really a regulation, it's a temporary exemption. So it costs a lot of money to get into this new market, and you don't know if that's going to continue, that regulation. So are you going to bet on that? Then requirements are very complex. It's difficult to get in there, to get approved. And until now, there were not digital cash alternatives to trade, because, I mean, you either have to be totally connected to the traditional rails, which is not easy, or you have to use the digital euro that it's not here yet, and we don't know if it's going to be digital. That's the other thing. And as far as I know, it's not going to operate on blockchain rails, so it's not going to be interoperable with digital assets. We didn't have euro stable coins. Now we have, so that's going to facilitate this business. But it's not that easy, and sometimes regulation is not proposed or designed by open-minded people, but just by the traditional guys that are not trying to do things different. It's like adapting the traditional way of operating.
You know, and I mean, it makes sense coming from their perspective. In many ways, it's a very risk-adjusted system, and there are sort of like the frameworks and like guidelines around traditional finance are there for a reason. And one of the challenges that you see in particularly when we're thinking about trying to regulate DeFi, for example, is, you know, actually how can you pinpoint who is responsible if something goes wrong? And we know from experience in traditional finance that can happen. But I think to your point, Coty, there's a lot that's actually taking place that's helping sort of that greater convergence along sort of, you know, policy or regulatory clarity all the way to some of the tech that's being developed and standards. And so I want to move to Rowan, who is working at DTI Foundation and who are doing some incredible work. I think that Haida was just touching on a little bit earlier. And so it'd be really great to get your perspective on, you know, how that's an additional element that's supporting, I think, you know, what Ben and Coty are alluding to, and everybody here on this panel, which is the greater convergence between the two, but how the standards element can actually support sort of that bridge between infrastructure and policy nearly. I think that'd be quite helpful.
Yeah, I absolutely agree that I think for any type of scaling from an institutional perspective, they need that regulatory clarity from a foundational level. And that's already come out in the last few years. We've had a lot of regulatory clarity, a lot of guidelines, a lot of consultation papers that are still being built up. And I think there are some grants as well available to get everyone involved, like in Singapore and Hong Kong. But in terms of going back to the standards, I think it's quite similar to the traditional financial world. One of the biggest issues in operating infrastructure, any businesses, is data management and interoperability. If you're not working off the same template and using the same language that your industry peers are doing, you're going to have a bad time, probably. I think in terms of policy and what's happening in the industry, there's been a few interesting projects and initiatives coming out over the last 18 months, and that's where the industry leaders are working with regulators on real use cases, like in Project Guardian. That's a really good example. But essentially where the magic is happening is where regulators are looking at what the industry has done and looking at these standards and looking at how to actually make this work and then integrating that into some kind of regulatory policy, which is building. So I think that's the most critical thing, where you have the regulatory policy, but also integrating what the industry is doing and what they see is going to work for this data and interoperability for the future-proofing of what they're doing.
Maybe a little additional point, right? Everything describes is true, but what really is the problem is fragmentation of liquidity, right? The true issue when I look at it is even if we have everything you just described, which I think is a prerequisite, correct, right? It's a prerequisite to get there. If you have cross-chain interoperability, you have standard data sets, you still have fragmented liquidity. Capital markets never go towards places that have less liquidity, right? So I think from a policy and regulatory perspective, if you go in the more traditional rails, the orchestration and helping or encouraging through policies and other means, central liquidity pools, central places where assets are commonly held, and then I think the data becomes also more standardized, because if you have just a few places where those assets are created, they can enforce the standards, the industry agrees to it, and I think that's a progression. But the liquidity is the key, right? I think, look at American capital markets. Most of the assets are held in the DTCC, right? Or the Fed, if it's US Treasuries, they're held in the DTCC. So a central place that has a register of all the securities created, and they are traded there. That means all the liquidity is there. Would people go to a different place, even though it's super cool, it's blockchain, it's super fast and cost efficient, with a fraction of the liquidity? No, because what do you want as an investor? The best price, right? And you want to get out of the assets whenever you want to, because otherwise the risk weight of that asset is different. And I think that's things we shouldn't underestimate. So the orchestration of liquidity, besides all the technical on all the other topics, is maybe a new topic to policymakers and others, right? And I think central bank money can play a role, but also, I mean, and we touched, what is the new commercial bank money, right? Banks trade and come on each other in new forms of money. Maybe a stable coin is that, but how many stable coins do we need? Do we need a master stable coin that is, or a standardized version that is easily exchangeable? And I think those are also topics one should look at, but liquidity is key.
I would totally agree. Actually, I was wondering, Heide, if you have anything to add in terms of sort of the practical utility and implementation of some of the standards, because you mentioned that you were using, leveraging some of the tools that DTIF and ANA offer. So wondering if you have anything to add on that front.
Thank you. Yeah, I mean, the biggest request that I have to entertain on a daily basis as a data processor is, can we see all of market? And I think you raised an interesting point about fragmentation, because that's how capital markets operate. But I also believe it's horses for courses. Because, who are the people looking for those assets, or who are the people looking for those for that type of exposure? It's wealth managers, it's family offices. They're looking for that exposure because they want to either put it into an ultra-high net worth portfolio, or they want to give that exposure to a alternative asset class that you can't readily obtain through your normal broker-dealer relationships. Now the question is, I'm a pension fund. I'm highly regulated in multiple jurisdictions, and my investment committee is asking me to invest in something that was crypto-like, because I'm missing out on a huge return for my beneficiaries. Right? Now the question is, as a pension fund, where do I go and seek that exposure? I could go to the buy side, and give them a mandate, and where will they look for that exposure? They will simply go and look at ETFs and exchange-traded derivatives, maybe structured products if they can, be minded to look at something so exotic to try and get me that exposure as a pension fund. Otherwise, it's not happening. So many of these players may miss that chance, not because they are not interested in it. They're going to miss that chance because they cannot find that exposure reliably through a regulated mechanism if that means was not available. So what Rowan touched upon about interoperability and standards, it makes a lot of sense, because if I'm offering you something as a pension fund that says, this is regulated, it has all the dimensions of or features that you are interested in, meeting your regulatory obligations, your reporting frameworks, and that you can satisfy your fiduciary responsibilities as well as your regulatory reporting responsibilities, then I will buy that product and incorporate that into my allocation. Until I have that, I don't. And so it goes back to what I was saying, is that once this thing hits that $1 trillion threshold in terms of notional, it is then viewed as a grown-up market. It is then viewed as a market that I can really do business with, because it has shown me that it has potential not just from a regulatory principles perspective, but potential from a sustainability perspective. And that should not be confused with ESG. Sustainability is that this thing is not going to go berserk on me when markets go southwards.
Yeah, I mean, I couldn't agree more, and I think a lot of the silver lining here is about finding the right vehicles to access new products so that you actually get buy-side buy-in, which is one of the sort of critical enablers, I think, when you're looking at anything from TradFi moving into more formal like digital financial market infrastructure, all the way to bridging into crypto strategies, all the way to that. So, Roy, I'd be really curious to get your views on sort of what do you think are going to be the sort of stronger enablers going into 2025 as to what's supporting that convergence? I think Ben earlier mentioned the dichotomy a little bit between early innovators all the way to adopters, and I think it's that there is a bell curve that exemplifies that exactly, right? And I think we're in that transitionary period, and I'd be really curious, from your perspective in the work that you do, what's enabling that stronger buy-in at the moment, and what will help fuel that convergence?
First of all, if you don't mind, Madeleine, I would like to reverse back for a second about the market infrastructure that we have. I think that the main challenge that we have as of today is that we are running basically two infrastructures, one called traditional finance, the other called decentralized finance, and we're not speaking in the same language when it's come to compliance, right? So tomorrow morning, if I want to open a trust wallet or to buy the ledger in store and to open my wallet, it is basically today like a bank account. I can get, for example, $1 million inside and transmit out $1 million out, right? And nobody is asking me for documentation, right? For invoices, for agreements, for anything else. When I'm going to traditional finance, for example, in Banco Santander, I'm sure that you will ask me what exactly you are doing, what are my social funds, right? Which documentation I can declare in order that you can be satisfied to move my funds out, right? So this is the main failure that we have today. And we need to understand that we have 450 million registered users today just in Trust Wallet, right? We need to understand the Trust Wallet, the decentralized application, is basically a gateway without any financial regulation that is connected directly to EVMs, such as Ethereum, Tron, whatever. This movement is a bit dangerous in my opinion, and I think that this needs to be addressed. First of all, it needs to be addressed because it might be that in 5-10 years from today, we can be in a position that traditional finance users, right, will understand that here they need to declare in many operations that they are doing. In the decentralized finance, they don't need to declare nothing. So then they will say to themselves, okay, so maybe it's better to move to decentralized finance and not to be inside the banking infrastructure that we have today. And I'm sure, and by any data that we have today, around 74% of the crypto users are telling today that they prefer to do a self-custody and not centralized custody. And I think that this one needs to be addressed. First of all, as per the regulations, that needs to understand that we have two streamlines that needs to be one connected, but needs to be the same, I would say, requirements. It cannot be that one market speaks in one language, the other one speaks in another language. This is one. And I think the main key here is to do a blockchain mass adoption inside the banks and to lead it to a position that the decentralized finance is integrated with the traditional finance and not separate from it. Now, regarding your question about 2025, so I would say that first of all, we're seeing in the US through Trump's administration, we have every day new surprises there. So we're listening every day to see what is going on there. In the last, I would say, 1 or 2 weeks, we're seeing that they, first of all, prohibit the CBDCs in the US. This is one. And I think that it's very important to understand that once for all, the US declared that they are not going to use CBDCs per definition. Now, the second item, it's about the framework.
Which CBC, right? Which CBC though? Do you know?
Excuse me?
Which CBC? Is it the retail or the wholesale one?
No. It's about the national stable tokens. As of today, the administration of Trump said that it's not going to be implemented.
But nobody knows if it's a retail version for sure, or if it's wholesale money, which
no
is already
clarity.
I'm not sure if
At the
they
end-
know either.
There's no clarity on that front yet.
At the
That's
end,
what I
we are
was
going
saying.
to stable tokens adoption. This is a very, I think, obvious for all of us. The framework that they are doing right now is a federal framework. During the next 180 days, they basically want to get once for all understanding of where U.S. and I think that it's about strategy, where the U.S. is basically going. We're seeing the same thing, not similar, not the same thing in Europe with MiCA regulations, as Coty said about the first issuance of MiCA licenses, and right now we're getting pre-registration through MiCA. And I think that this movement is basically leading us to a point that eventually we'll be in a position that we need to decide what we're doing with this industry. We are centralizing the decentralized world, or we are basically moving together to be in a position, as I mentioned, that we have two markets, and then people need to choose where they're going in to use and manage their financial life. I think it's not smart, and I believe that the main thing that we need to do right now is to concentrate. We're bringing a next layer of compliance to decentralized finance, something that we must do. This is one. And second, afterwards, we can actually go to the banks, commercial and national banks, and tell them, okay, so right now we're in one stage, DeFi and traditional finance, and we basically can move forward to true adoption of blockchain. And I think that this is the most important thing, and this is what we need to concentrate.
I mean, as you just alluded to, the market appetite differs, right? And so the signaling around that, I think, is pretty important. And whether you, like, depending on how you target your audience, and that's sort of either from a, folks building out the infrastructure from a tech service provider or institutional perspective, all the way to the retail audience. If that really does come down to it, the appetite is different, and understanding of those technologies is different. And I would tend to lean on the grounds that insofar that you have very different appetite, there's not one fit for purpose or one fits all kind of model yet. But we're seeing, as you said, or alluded to with the Trump administration, a lot of movement that I think is shaping market dynamics quite significantly. So just to wrap up, I wanted to take a moment to think about that and the implications from a policy perspective and a market competitiveness perspective as we go into 2025. So yeah, if there are any concluding thoughts around I suppose the US's change in policy perspective, and what that might lay the ground for in the coming year, Ben, I'd be really open to your perspective there.
So I think if you look at the CBDC decisions and so on, I think it's a continuation of dollar dominant strategy. Very clearly, crypto is fully dollar dominated. The moment you allow regulated US dollar stablecoins to be used globally, you enshrine dollar dominance into the new digital age, right? I think it's a very, very smart strategy from an American perspective. Tricky for us in Europe because we have a lot more limitations around the stablecoins and the stablecoin industry. And this way we will never get the market share we now have in euro settlements for assets versus dollar settlements. So I think that shift, people have to understand, that's a very specific shift that's happening because crypto is retail, right? The one thing, the final thought I have is, we now already have fragmented capital markets. You go to your bank, you go to Santander, and you buy in the European capital market. That's a completely different market with a different currency to US assets and to Asian assets, right? Crypto is just another marketplace you have. I think the challenge for the traditional industry is to ensure, and I think Coty, I think Rowan made that point, to ensure that the traditional markets get in a more innovative digital rails so they can offer the thrills and the opportunities and the speed the new, more crypto DeFi markets offer, so they don't lose market share. It's just a wallet attribution. Now you spend 20% in crypto, and if the future of capital markets is a little bit more like crypto, right? Technically also able to offer those solutions, you might keep your 80% there and still do 20 crypto. Everybody won, right? But the problem is, for traditional players, if the money shifts to 50-50, right? And 50% just stay in traditional, and 50% wallet share goes to the new crypto and DeFi rails. And I think that's the true challenge, right? That's where the little secret will be, and I think that's where people have to start to focus on for 2025 and going forward.
Yeah, I mean, Rowan, I wonder if you have sort of any additional thoughts on that front. We're running short on time, but I think that given where you sit in the industry, I mean, there is that sort of like that small silver lining really between the two. So yeah, I'm just curious if you had any additional views.
I think from our perspective, the most important thing for 2025, just continuing, is working as much as possible with the other industry standards that are out there to make sure that they all do work together and they're actually making something bigger instead of making their own silos a lot of the time. So you don't want to have one small part of the industry creating their own language and then another part of the industry which should be connecting with the other part using something else. So I think it's really important that what tools are being used today and what tools are being used in the future, they're the things that are going to be bridging this tradition, the TradFi and DeFi, and they need to work together, full stop. Nothing further than that, basically.
I mean, from my perspective, it's sort of like it's the harmonization between infrastructure that operates sort of in a harmonious way in both ecosystems that is sort of the real bridge, and the only enabler to that is sort of the kind of policy framework. So we've been unpicking now for a little bit. So thank you all for your really insightful comments. Really enjoyed the discussion. If there are any interested follow-ups, please do try and catch us on the way out. But in the meantime, I'll hand back over to our MC. And thank you everybody.
Thank you, Madeleine.